So we move into part 4 of chapter 23, standard costing and variance analysis. We've covered a fair amount of ground already. We're going to now move into slightly more complex variances, but broadly speaking, our approach will be the same in terms of formulas, reasons, etc. Let's take a look at this next area, which is fixed production overhead. Now, we saw earlier on in our studies there's a difference between non-production and production. We're talking about things that are directly linked, let's say, in a manufacturing context to the manufacture of a product, let's say. So let's look at the first area here and the different types of variance. So first off, when we think about production or indeed production levels, I guess what we need to bear in mind is that the higher the level of production, the more beneficial it is with regard to fixed production overheads. Why is that? Because we're talking about something that is a fixed cost. And if we increase production levels, then in essence, we've got economies of scale, haven't we? In other words, we're spreading our fixed costs over more units, okay? Now, we also note from our former studies the difference between marginal and indeed absorption costing. And this is important in this context because when we think about marginal costing, let's remember basically revenues less variable costs. In that type of system, let's say we're operating a company, we're using marginal costing. Note that there is only one fixed production overhead variance, i.e. the expenditure variance. Now you might think, well, why is that? Well, let's think about the concept. The concept is that really fixed production overheads technically don't affect production because we're only dealing with revenue less marginal or variable costs. This is explained here. Basically, we're not absorbing into the cost any fixed element. Note, obviously, with absorption costing, we're absorbing fixed production overhead into our units. So in essence, I guess this final point here, that the fixed production overheads are treated as a period cost. In other words, they're charged to the profit and loss account in a given period. That might be 1 month, it might be a quarter, etc. Now on the flip side, as we just said, absorption costing, note that basically the fixed production overheads are going to be absorbed into units, okay? Now that has an implication, obviously. Let's think about it, because in essence, if we're absorbing into units, then we're bound to have some sort of over or under absorption based on what's actually happened. We must have. So note the difference here. If that's quite a lot of information to take in right just now, I understand. But let's just think back to the fact that we know that those two different types of costing work in completely different ways. Moving from there, in terms of key point, so in essence, absorption costing is going to give us this idea of under or over absorption within a given period. As we've just said, just to sum up, only one fixed production overhead variance, i.e. the overhead expenditure variance. What is that? Just the difference really between actual fixed production overhead and budgeted. So quite simple really when you think about it, just one figure from the other. Note that in terms of the overhead expenditure variance under both systems, they're calculated in exactly the same way. That will open itself up when we start to see more and more OT questions. Okay, so moving from there into the calculation. So let's talk about the fixed production overhead total variance. So in essence, that total variance is just simply the difference between fixed production overheads absorbed and actual fixed production overheads, of course, incurred. So we're going to have, obviously, under an absorption system, we're going to have over or under absorption. In terms of the calculation, You can see the calculation here. Now again, I've said previously in the first three parts that rote learning or memory is important in the first instance. A full understanding of, for example, well, why should it be actual production units? Why should it be standard absorption base per unit, etc., etc. A full understanding of that, not needed right just now. I think what we need to do is memorize, okay? So you can see that we get down to basically the difference, or indeed the variance, either plus or minus, or favorable, or indeed adverse. Moving from there into the expenditure variance. What we know about the expenditure variance, as explained up top, is really, in essence, the difference between the budgeted fixed production overhead expenditure and the actual fixed production overhead expenditure. And moving on from that, the fixed production overhead volume variance. So, i.e., actual production volume differing from expected production volume. Again, in terms of the formula, a lot of information here. You may be wondering, why are these elements a part of it? For the moment, let's just say to ourselves, we know what we're dealing with. We know that we're dealing with fixed production overhead. We know that we have two separate approaches, i.e. absorption or marginal. Let's at this stage simply learn the formulas as shown, giving us the expenditure variance here. Moving from there, now causes. Now again, as I've said previously, this area of causes for different variances is important to us. Yeah, absolutely. Now you may wonder to yourself, well, where you have a fixed production cost, e.g. a factory rent, canteen, etc., etc., why would they change? Well, anything can happen. Anything can happen. It's very, very difficult to accurately predict down to the last cent, down to the last penny, etc., etc., what's going to happen in the future. So in essence, what we're talking about here, if you accept, well, yes, there can be variances. We're just talking about, either higher or lower, given the actual figures, okay? Now, in terms of a summary, quite a lot of information here. I don't propose to read through each of the 5 points, but these 5 points here are a good summary because they summarize basically what I've just been through. You'll see that I've cut and pasted this directly out of the study hub. Okay, so do remember what I said in this part 4. Certainly the variances and the calculation and I guess the theory behind them gets a little bit more tricky as we move from each part. This area here, I would say, if you're maybe a little bit confused, I would say understand that, because certainly, sales, material, labor, etc., reasonably straightforward. It's a little bit more complex. Let's move from there in terms of the fixed production overhead volume variance under absorption costing. Now, we know what absorption costing is. We're simply talking about the idea that due to difference between actual and expected production volume. Okay, so we anticipated this volume, but we actually achieved this volume. That's what creates the variance. And again, our formulas are here. The formulas, the constituent elements, in other words, the key parts, aren't overly complex to understand. So, for example, if I said budgeted production units, that should be fairly straightforward to figure out from the question scenario. If I said, well, overhead absorption rate, again, fairly easy to pick out from the scenario. I guess the problem in this sort of area, and what makes this part 4 a little bit more complex, is the formulas are several part rather than just 2, and the theory surrounding fixed production overhead is a little bit more complex. Moving from there, in terms of the causes of fixed production volume variances, a number of things could be in play. For example, strike action. Okay, outside of that, machine breakdowns, maybe fall in demand, maybe shortage of labor, maybe increase in demand. So again, if you're stuck in an exam, and you're faced, for example, with something relating to the cause of a production overhead variance, try and think logically. try and think common sense. At the end of the day, when you read the model solutions to the OT questions in this particular area, even though I would say it's certainly the trickier of the first 4 parts, much of it relies on some common sense, that's for sure. Okay, so in terms of the reconciliation of the sort of total production overhead, total variance, I mean, obviously we're talking about these 2 things. Yeah, we're talking about the comprising fixed production overhead expenditure variance and fixed production overhead volume variance. So really in this area, we're talking about expenditure and volume. Okay, now, one other key point I've mentioned in each of the chapters is this working backwards thing. All that means, and I'd ask you to work through the relevant section of the chapter, is just being able to go front to back and back to front. In other words, to be able to go from the variance itself, if you're given it, back to the individual calculations. Okay? Outside of that, in this particular chapter, we sort of have an add-on, a subdivision of the overhead volume variance. Okay, so we haven't had this in any of the first 3 chapters. In essence, what we're saying is, okay, up top we looked at the overhead volume variance and we saw the calculation in the formula, but we can further break that down into a capacity variance and an efficiency variance. I mean, when we think capacity, we just think capability. What are we able to do at full pelt? And when we think efficiency, really, how efficient are we at doing what we're supposed to be doing given our standards? Okay. So in terms of, the reason to break down the overhead volume variance into 2 further variances, in essence, it just gives us more MI or more management information. We'd like to know really with this, let's say, adverse volume variance. Okay, say it was massive. We'd like to know what sort of caused it. Is it something to do with our capacity? Are we working at full capacity? Or is it something to do with perhaps staff and indeed efficiency? Okay, so the capacity variance first. Note, it's difference between planned hours of work and actual hours of work. So you can see how that ties in with your capacity. This is what we should have been. We should have been working 60 hours a week. We actually worked 48. Okay. Now, note that if the actual hours worked are more than budget, obviously the variance is favorable. And the reverse is also true, because obviously the more fixed overheads can be absorbed. And in terms of the formula, reasonably straightforward, several parts to it. Just try and remember that when we think of capacity and efficiency, we're looking at 2 parts to the volume variance. Again, we could cut and paste these into another section in your notes perhaps, and this could be part of our rote learning area, and then we'll apply to the questions. Moving from there into the efficiency, the second one, what do we mean by efficiency? Well, broadly speaking, how smart or indeed efficient the organization is, okay? So, in essence, what we're saying is combining this with capacity, we have quite a lot of information, okay? So again, in terms of the calculation, not too bad. This is one for us to rote learn, just very basically, actual production units, standard absorption base per unit, okay? Now, note that in terms of this particular area, if an organization is smart, it's getting sort of favorable variances, then certainly this should be in the form of over absorption and certainly long-term reductions in fixed costs, or indeed increases in profit. Okay, so in essence, that's our part 4. Again, as I said, really from the off in part 1, it gets a little bit trickier as we go, but again, as I've said, let's follow our sort of route of formula rote learning and causes. Okay, I hope that made sense. Many thanks for listening.